e.l.f. Beauty stock just crashed 20% after its earnings and is still down by 20 to 22%. So is this a golden buying opportunity or a warning sign for investors? So let's break the numbers and see if this stock can double from here. So hey everyone, welcome back to my channel once again. This is your friend Abhishek, but not a financial advisor. And in this video, we will dive into e.l.f.'s earnings report, why the stock dropped, and whether it's a smart buy right now or not. We will also analyze its valuation, growth potential, and some key risks. So if you are a current investor in e.l.f. Beauty or are thinking about buying e.l.f. stock, then stay tuned and watch until the end, because you are definitely gonna find some really good value on this high growth stock or not for the year 2025. So like I mentioned, net sales 31%, which is not that bad at all. Adjusted EBITDA was $69 million and they are actually growing quite rapidly in the market. So here we can see that for the fiscal year 2025 second quarter, they expect a growth of 14 to 16%, which again is not that bad. And now another bullish point and an important point for e.l.f. Beauty is that now they can penetrate the market via these retail stores like Walmart or Dollar General, and that means that they are democratizing the access, which is quite good for the top line, to be honest. And this slide shows quite an important thing for all the retail investors who are interested in getting into e.l.f. Beauty stock, and that means we have a significant runway for growth. So 14% is actually the leading brands, and e.l.f. Skin has just penetrated around 2%. Now in this market, guys, to penetrate is not that easy, especially when you are competing with brands like Garnier, L'Oreal, Cetaphil, Olay, La Roche-Posay, CeraVe, and these companies have been there since hundreds of years, while e.l.f. Skin is just 5 years younger. So of course there's a huge competition, but that also means there is a huge opportunity. But like I said, if there is a problem with the US tariffs, we could still see growth from the international net sales, and this slide shows us that that is possible because 66% international net sales growth is phenomenal, guys. And in the international penetration, we could see that for the fiscal year 2024 it was 15%, and they expect to be at 20% in quarter 3 fiscal year 2025, which is not that bad at all. So combining them both, I do expect that in the coming 4 to 5 years, they could still grow at a rate of 30 to 40%, which is phenomenal in my opinion. At this particular price, 30 to 40%, I do think that this stock could double. And guys, 71% gross margin is huge. It's huge, and this is what they also expect for the year 2025. Now this is where the things are becoming more not so efficient for the business. So the adjusted SG&A, the operating expenses, are huge for this company, 50 to 60%, and this is what they expect even in 2025. Guys, this is one of the points which I don't like. When the top line growth is increasing, they should be able to make the business more efficient, reducing the operating expenses. And I do see that their operating expenses has been increasing, and we will get on to that in a moment as well. So to visualize via chart, and this is what is one red flag for me. And you can see that the marketing and digital investment is increasing, but yet for the quarter 3rd fiscal year 2025, they do expect an adjusted EBITDA of 16%. So now for the fiscal year 2025 outlook, and this is where the stock price fell, they expect a growth of just 27 to 28%, which, like I mentioned, I do expect 30 to 40%, and this is what the investors were also expecting. Actually, the business was growing at much faster rate than 40%, 50 to 60%, but now it has come to almost half of the growth rate. But this is, again, the CEO mentioned that these are some temporary headwinds for the business, which will disappear in the year 2026. And of course, there are many uncertainties like the tariffs and so on. But the outlook for the gross margin remains quite impressive, 71%, and the BPS plus 40. So that still means that they are acquiring a decent chunk of the market share. So this is quite important because this is the number which we will use for our evaluation. So adjusted EBITDA to be at plus 23 to plus 25% year over year. So that is quite good, and you will see why. So now let me show you what I meant by the SG&A expenses is actually eating a lot of their cash flow. So you can see that the total revenue has been phenomenal year over year, but you can see that a massive chunk is into operating expenses. So it's a negative thing, but we have to understand why they are doing so. First of all, they're competing with giants, big giants who
who are there in the industry since hundreds of years, and even they spend tons of money into marketing. So the biggest chunk of this SGA, like we saw, 28 to 30% is going into marketing. So I do understand that they do want to penetrate the market, so it's okay. I do want to see that these SGA expenses, operating expenses, go down. They should make the business more efficient, because you can see that so like 40 to 50% is SGA expenses, 50 to 60% of the total revenue is operating expenses, which is why we are not seeing a significant growth in cash flow. And this is what I want to see. I do understand that they are in growing phase and they have to spend a lot of money for marketing, and yeah, and if it's, but we can see that the marketing expenses did not decrease even when the revenue declined quarter over quarter. So this is not that good to see. You can see that the marketing expenses, the operating expenses were the same when the revenue declined. This is what I don't want to see really as an investor. If they know that there are headwinds, then basically they should be able to reduce at least the marketing expenses. So anyways, that's what I don't believe that they should have done. But now let's see for the future quarters. So this is one red flag for me, but there are a few green flags as well, like I mentioned, and the biggest green flag for me is the valuation model. So let's jump on the valuation model. I have taken net income into earnings as my metric because I do believe their free cash flow is a bit unstable, so I'm not taking that into consideration for my valuation. And a metric growth rate, I have taken 20% into account. So like we saw, 25 to 27% they are expecting to grow. And a price to ratio, I have taken not 221. This is not realistic, so I have taken a realistic price to earnings ratio of 30. Yeah, so this is what I do believe that they can be evaluated at. I see that the future stock price could be at $124. Now, why I think that the stock price could double, because if we just take the expected metric growth, we can see that the future stock price is at $150, which is 114% upside potential from the current stock price. And that means we are beating the market as well with a compound annual growth rate of 16.5%. And to do this, they would have to generate a net income earnings of $329 million, which I do think is possible. Now, their highest net income was around $129 million, $130 million. So I do think that they can achieve this in the next 5 years if they continue to grow at this pace and there are no headwinds taken into consideration. So that's it, guys. That's all for the valuation model of e.l.f. Beauty.
So that's all, guys. That's all for e.l.f. Beauty. Do you think the stock could double from here? Well, let's discuss in the comment section down below. And you'll see me in these two videos because these two stocks are quite amazing as well and are doing quite well since I made a video on them. So until then, stay safe, stay happy, and ciao.